Now, the corporate level and developing of strategy at the corporate level. I sort of mentioned SBU before, and in this case here, we will also hang on to our different kinds of analysis from the environment and the resources. So bear that in mind, that every single SBU are doing environmental analysis and resource analysis. Good. Let's try to put it into the context. As we talked about before, we have environment-based options, and down here we have resource-based options. And now we are focusing on here the corporate-based options. So what is an SBU? That is one of the first questions we need to ask ourselves. And it will make sense in a very short while. But a strategic business unit, also just called an SBU, has what we call three characteristics. And just for now, think of an SBU as a single company. And imagine that you have your own pizza company again, and you are the only owner. And you may have some employees as well. Then activities, that you can plan your activities, and you can plan them separately from all other companies that you are basically competing against or might even own. And you also have your own set of competitors, and you are the manager, and you are responsible for strategic planning, profit performance, and you control the factors that affect profit. And that's a little tricky one, this one, because profit performance, to be responsible for performance within profit, it also means that you need to control the factors that affect profit. And if you have, let's say, a subsidiary, and you have a CEO in that subsidiary, and that CEO is actually responsible for the profit performance, and might have a bonus based on profit performance. And then the mother company, the corporate, say, okay, you have to buy these raw materials from us, and we have decided that the price or the cost to you for these materials are going up with 200%. That means that the CEO might be responsible for the profit in the subsidiary. But if the CEO cannot control, for example, the factors, one factor could be the buying of raw material that affect the profit, then there might be, well, maybe not satisfaction right here. And we do see that a lot, that when we start talking about corporations, they say, okay, these are real SBUs. Yes, but do the guys also control the factors affecting profit? That's always a very central question. But for our case, let's imagine for a moment that we have bought these three companies, and we have simply saved a lot of money for a long time, and now we have gone to the bank and said we would like to have our money. And then we have had a meeting, and we have decided that we are going to buy, and we have bought Vestas, and we have bought Lego, and we have bought Tesla. For some reason, these three companies have been out for sale, and we have simply just bought them. So now we own these three companies. Now, if we look at them from an SBU point of perspective, then they all have the characteristics 1, 2, and 3 up here. We still have to hang on to we own them, okay? We own these three companies. So can Vestas' activities be planned separately from Lego and Tesla? Yes, they can. Can Lego's activities be planned separately from Tesla and Vestas? Yes, they can. Okay, and Tesla, the same. Point two, it has its own set of competitors. Do Vestas have its own set of competitors compared to Lego and Tesla? Yes, and the same goes for Lego and Tesla. And three, does Vestas have a manager that's responsible for strategic planning, profit performance, and control factors affecting profit? Yes. Does the same go for Lego? Yes. Does the same go for Tesla? Yes. So they all have the characteristics of an SBU, a strategic business unit. Super. So since we own these, we become the corporate headquarter. That means because we own them, it's ours. And therefore, we are now the headquarters. So if Vestas wants to do something that might be different from what the overall strategy is, then they have to walk down or up or whatever you would like to call it and ask us, because we own them. They cannot do something without asking the corporate headquarters. Now, since we own them, we can also decide what we want to do with them. And that's important when we are talking about the corporate headquarters and talking about SBUs. So let's try to see what that means. Now, since we own them, we can decide what we would like to do with them. So some questions that we might ask ourselves could simply be, do we want to sell one of them? Probably, since we have just bought them for our savings, we won't sell them right now. But imagine that we have owned them for a long time. Then we might consider, okay, would it make sense for us to sell Vestas, for example? Or what about Lego? Would it make sense? And why should we do that? So that's a strategic question in the corporate headquarters. Do we want to sell any of our companies? Now, if we are going to make a good decision about whether we would like to sell Vestas or Lego or Tesla, we would probably like to have some more information about the future for Vestas. That means we would like to have an insight into the strategic position of Vestas. And that brings us right back to the environmental analysis and resource analysis for Vestas. So we cannot really decide to sell or close Vestas unless we have investigated the conditions of Vestas. And that goes for all the companies that we own. We need insight into the strategic position, the strategic analysis, and especially the key factors for success. That is, of course, one thing. We could also ask ourselves, do we want to expand one of them? And if we want to expand Vestas, should we then maybe have some of the guys from Lego to join the guys in Vestas and help them? And would it make sense? And that would be the question down here. Are there any synergies between Vestas and Lego, for example, on the employee side? Do we have any economies of scope between the three companies? So they have some value chain activities that might be the same, and where we could benefit from having those scope activities taken care of in the corporate headquarters. So maybe we decide that some activities taking place in the company of Vestas and their value chains, we take that up to our corporate headquarters level, because we can see from here that the same activities takes place in Lego, and we can also see same activities takes place in Tesla. So we decide that these activities are now brought up to the corporate headquarters because we can do it better than they can, and we might save some money, and that would help us to be more competitive in each of the marketplaces. So therefore, these questions are pretty good to ask. And also, do we want one of them to help another one? Should we move money around? Should we move people around? So as you can see, corporate strategy is not really difficult. It's simply about asking specific questions about what to do with our companies and how can they support each other and how can we make them support each other. So that's one of the major activities of the corporate headquarter. It also means that when we have a corporate headquarter, the people employed here, they should be able to comprehend all the different kinds of information from Vestas, Lego, and Tesla. And if they can't, then they may not produce any value to the corporation. So therefore, it is important that the corporate headquarter produces value to the whole corporation. Again, let's go back to us. We have saved our money. We have bought these three. But if we are not able to supply these companies with anything that gives value to their position in the market or help them to save some money so that they can create a larger profit for future investment, then we are not producing any value. And we should do that. Otherwise, we should simply just own them and let them be. We could also, of course, consider buying Netflix. This might probably be a good idea right now. But that's the basic idea. So let's try to take a little closer look at this idea about the corporate level, division level, and SBU. Now, up here, right now, I have talked about the corporate level and the division level. The division is simply to say, okay, this is the corporate headquarters for the whole world, just as an example. Then division 1 could be Europe. SBU 1 could be Denmark, SBU 2 could be Germany, etc. And the same goes for the other parts here. So I'm not going to talk about the division part here, just talk about the corporate level and the SBU level. The corporate level, what is it that we are doing? Well, up here. First of all, of course, we need to have a discussion about our vision and our mission and our objectives with our corporation as such. Then we have to define our strategic business units. Well, as examples before, it's pretty easy when we have just bought 3 companies. But in lots of cases, we must probably define our SBUs because it's not that simple in reality. But having defined our SBUs, we have to assign resources. Means we need to have an agreement with each SBU. What kind of resources do you need in order to do your job? Then we have to plan for new business, and we may have to downsize older business. That means we may have to plan for setting up new SBUs, and we may have to plan for closing down SBU number 3. So that's basically what goes on here on the corporate level. Defining our SBUs, working with the resources, and planning on how should they perform and do in the future. Now, at the SBU level, they do business strategic planning, and that's what we have been talking about before as well when we do strategy for the SBU. And here we, of course, have business mission, SWOT, goal, strategy, etc. And each SBU may have different products that they are selling. And for these products, we do a marketing plan and maybe a product plan. So if we are talking marketing and marketing courses, etc., we're normally talking about this level here for this product, and we might have some indications about the company as well. In this course here, we are more interested in the SBU, the company as an overall entity, and how it is placed maybe in a corporate context. And in this specific lecture, we are talking about the corporate level. Now, Ansoff, the guy that we know has this matrix, he would say that when we are at the corporate level, we are here. We are talking about whether the SBU should close down. That means, should we, as the corporate headquarters, should we close down this company? It could also be, instead of closing it down, that we simply sell it. Then he would also say that we have diversification, and it is up to the headquarter to figure out, do we have any related or unrelated issues regarding our different SBUs and the way we would like to develop our corporation. So diversification is quite a central issue here. And looking into different kinds of diversifications, then we have these degrees of diversification. So we have close related diversification. That's where we have common customers or, for example, common suppliers. So we may not produce exactly the same product, but we may have some of the same customers. For example, if we have Vestas, they would sell their products to governments around the world. And if we have another company selling solar panels, for example, they would probably have some of the same customers, but it's a different kind of technology. So that would be maybe a close related diversification if we wanted to buy a solar panel producer. Then we have a distant related diversification. That's where diverse products, but underpinned by core technologies or competences. That's where we are focusing on the technology, but we may have quite different kinds of customers. And then we have totally unrelated diversification. That's where we might end up buying or having SBUs in our portfolio that has very little relation to whatever else we are doing. And therefore, these 3 degrees of diversification help us to understand whether there might be good options for having synergies between the companies. So what we need to understand about diversification options here is we need to understand, and I'll take you back to a little slide here. These SBUs here, are they very, very different? If they are very, very different, then we would talk about us having unrelated diversification. We are diversified in a way that the companies are unrelated. Okay, then what about, let's go back again. If these SBUs are kind of within some of the same technology, then we would say, according to this, okay, all our companies, they are distant related. That means we are diversified in a way that we are quite distant related because we have a lot of technologies, competences that we are using, but in order to support different kinds of customer groups. And the last one would be that, okay, all of our companies, all our SBUs, they are basically servicing the same kind of customers, but with different technologies. So that would be close related diversification. Okay, good. Let's take an example here. I know some of you might have seen that we have Siemens Corporate View of Business 2004. That's lots of years ago. It doesn't really matter. I've tried to find a new one, but I couldn't. The newest one I have found, they more or less looks like this. What is important here is that if we look at this one, information and communication network, this one is one SBU. This one is another one. This one is yet another one. So we can simply count them and say we have 1, 2, 3, 4, etc. We have this overview of our SBUs. That means our corporate view of businesses. And as you can see here, medical solutions and information and communication network, are they the same? So therefore, a good question would be, what about Siemens and the degree of diversification? Is Siemens a company that is very diversified? And looking just into this, yes, it's quite diversified. They have lots of things that has absolutely nothing to do with each other. So we would probably find, going back to this slide here, that we have unrelated diversification, but you would also find that you have distant related and close related. So that leaves a lot of options for Siemens to develop and to take advantage of synergies when they are looking into what to do with their businesses. And for that, when you look at it, have lots of companies, lots of SBUs. So it's a simple question about how do we develop these companies? Do we also sell some of them? Do we close some of them? Do we move people around? Do we move money around? Now, having that in place, let's try to take a closer look at the benefits and the cost of having a corporate level. And I would like to focus on this box. And after that, I would like to focus on this one down here, the portfolio matrices. But first, let's look at the benefits and the cost. Now, the benefits of having diversification, and simply means to have more than one company and have more SBUs, is that we might have economies of scope. We've talked about that before, so there's no need to dig into that one. We may have the opportunity to transfer core competences across our different companies. That means if we have really good people in economics, or really good people in marketing, or good people in communication, we might want the good people to start in Vestas. And then after a year, we take these people and we send them to one of our own other companies. It might be Tesla, and help Tesla to develop on their communication. So we can transfer core competences. We can also share activities such as purchasing and distribution, economies of scope, for example. Then do we have some benefits external? Yes, there might be vertical integration, because through ownership of owning our own suppliers or outlets, we do control in a better way what is happening with our supply chain, and also with what is offered to the customers. So vertical integration. We also have used another word when we talked about the value chain. We talked about the value system. And vertical integration, that's when we kind of buy up the value system. We can either do it backwards or forwards. Backwards is when we buy our suppliers, and forward is when we buy our customers. Then we might have more market power, simply because we belong to a group and we can help finance specific issues. And then we might be able to block competitors through our market power. And finance, well, we could have lower cost of capital simply because we can borrow money from our corporate headquarters, and we can borrow money from other SBUs, but we do it through our corporate headquarters. Then we could have business restructuring. If we are facing competitive pressures, or it could be pressures from all kinds of things in the marketplace. It could also be economic pressures, it could be political pressures. We are more easily going into a restructuring because we have simply more resources and we can take that risk upon us. And then we can more efficiently allocate capital between the different SBUs in our corporation. Simply means we can have money lent out to the different SBUs, and we can put the money where they are needed. Okay, these were some of the benefits. What are then some of the costs? Well, if the headquarter, as you know, this is us right now, if we are too many and we want too much in salary, or we do not really help with anything, then we can end up being a burden to the group instead of actually being someone who's helping developing the whole group. Then something about the complexity and the management of diversified firm, that it is difficult for the corporate headquarters to have the skills to manage and understand truly diverse individual businesses. I talked about that just a minute before with the illustration of us not being able to understand especially what is going on. And then we may have a lack of competitive resource-based focus, because a diversified corporation is not really focusing on particular resource strength. As a corporate headquarters, we may actually focus much more on what is going on right now on the corporate level. And then do we need to divest, and we might hide low performing SBUs or low performing areas within the overall group, and maybe that's okay, but it depends on the strategy. If we are only profit centered, then of course that is a cost. If we are not only focused on profit, it might be okay if we are just think in the area to make green issues, or you want to make non-profit corporations, etc. Okay, so these were some of the benefits and the cost. Now let's try to take a closer look at the portfolio, and especially we are going to look at the Boston Consulting Group and the GE McKinsey. In your book, he's using directional policy matrix. That's the same as the GE McKinsey, but in my experience, no one in real life knows much about directional policy matrix, but they all know what the GE McKinsey is. So we'll take a closer look at that one. Now, first of all, when we are looking into portfolio matrices, we need to understand that a portfolio is something that is a large thin case used for carrying one's collections of drawings, documents, writings, investments, and then companies, etc. This is a portfolio, basically. That's how we understand it. But in our case, we understand a portfolio as the different kinds of companies that we own. And that's how we will define it. And then a matrix is a way to organize our portfolio using certain criteria. And we'll be looking at the Boston Consulting Group, which is this one, and we will be looking at this one, which is the GE McKinsey. So the Boston Consulting Group, the portfolio here, and we have, of course, remember that we have Vestas, and we have Tesla, and we have Lego. And we will divide them into, or put them into this one, and that is market growth and relative market share. And in this case, then we could have a high market growth, and we could have a relatively high market share. And if we look further down here, then we have the other one, which is business strength and market attractiveness. And the market attractiveness can be high and it can be low. And then we have the business strength that can be high and it can be low. Now, going back to this one up here, then looking into the market share. What is a market share? Well, a market share is the company's sale divided by the total sales in the market. So that's how we define market share. Then we have a relative market share. That is our company sales divided by the sales of our largest competitor. So it's not about our total sales in the market. And then again, it is, because we could also simply take our market share and divide by the market share of our largest competitor. But in this case, we will look at it in this way. And then the relative market share, if it is 1, what does it mean? Well, if it is 1, it means that if we sell for 1 million and our largest competitor is selling for 1 million, then 1 divided by 1 is 1. So that means we are exactly the same size as our largest competitor. Okay, what does it mean if our relative market share is below 1? That means we sell for 1 million and our largest competitor sells for 4 million. What is 1 divided by 4? That is 0.25. That means that's below 1. But what does it also mean? Well, it means that our largest competitor is 4 times larger than us. What if our relative market share is above 1? Well, if we sell for 10 million and our largest competitor sells for 5 million, then 10 divided by 5 is 2. And if we have a relative market share of 2, it simply means we are twice as big as the largest competitor. So that's an important definition to remember, that we have a relative market share, and it is the relative market share we are dealing with over here. Good. Down here, it's easier to see right away, but it's not easier to calculate. But the business strength is simply the conclusion to the strengths and weaknesses. And the market attractiveness is simply the conclusion to the external environment. Okay, let's try to see at the BCG growth share matrix. Now, we have here high market growth, medium, low. So that is market growth. That was one of the criteria. We have the relative market share, and we have here below 1.5, 1.5 and 1.5 over. Lynch says that in normal we will say we have to be above 1.5. That means we have to be 50% larger than our largest competitor in order for us to talk about us having a cash cow or us having a star, either in a low market growth or high market growth. So what do we do here? Well, we simply take our companies, our SBUs, and Vestas. We could take Vestas and say, where are Vestas? What relative market share does Vestas have? And they are pretty big. So let's just for a moment imagine that they are over 1.5, and they are in a market that is medium growth. So we would place Vestas here. We would do the same analysis for the other issues as well, these companies, and we would place them in this matrix. And as you can see, a dog is characterized by being not the largest and in a market that is not really growing. What should we do with that company? So it's about getting a totally different overview of our SBUs and trying to make decisions about what to do with them. And if we think back to all the questions I indicated in the start of the lecture, this is about, are there any synergies? Should we close it down? Should we open up new? Should we add someone, for example? What about Netflix here? Would it make sense to take Netflix? And where do we find Netflix? Is it up here? Do they have a relatively high market share in a very high growth market and therefore they are a star? Or are they operating with a very low relative market share and maybe in a market with low growth? Then they would be a dog. So the discussion about where to place Netflix and maybe buying it is an interesting strategic discussion. And in the same way, we do that with Lego. Is this the right place for Lego, or should we put Lego in another place? Good. Let's try to take a look at the GE McKinsey model. Business strength. We remember that is about our resources. We can be strong, we can be medium, we can be weak. It's basically what it says here. Market attractiveness. The market can be really attractive, can have a medium attractiveness, and it cannot really be that attractive. So I guess it makes a lot of sense saying that if we are really strong here, and we are strong in a market that is not really attractive, not many companies would like to be there. So depending on whether we actually make money or not, we would simply say protect that position and maybe refocus. Could also mean maybe we should consider closing it down. So the idea here is, if we have Vestas, Lego, Tesla, if we have these companies, we would make that investigation based on our SWOT and figure out how strong are they. And let's imagine that Vestas is quite strong in a very attractive market. That means we would place Vestas right here. Then in theory, the GE McKinsey portfolio model has this strategy suggestion to us, that if we conclude based on our analysis that this is where Vestas is, then they suggest we should invest to grow and concentrate on our strength. So they simply help us to by suggesting strategies based on our analysis of the position of the SBU. And if we have a business, let's say Lego, and we have figured out that we have a low business strength, but we are in a very high attractive market, then the suggestion from General Electric is to specialize around our strength and try to overcome our weaknesses, or maybe consider to withdraw from the market. So as you can see, we are back to our analysis of the environment. We are back to our analysis of our resources. We are concluding on it, and we are then concluding on an SBU level and saying, okay, the SBUs are found in these different places. What are the suggestions on a strategic perspective from the GE McKinsey? And how do we choose to act? Are we going to use money earned over here to put into a company that is low on strength right now, but in a very attractive marketplace? Maybe yes. How should we do it? Do we have any synergies? Can we take money? Can we take people? And how do we support the development of this? And we can do that because we have SBUs, and we can use that and the resources they have. Good. So how do we calculate this in the GE McKinsey model? Well, I have made this just to indicate that we have strengths and weaknesses or attractiveness down here, and we have to use criteria. And if we have a criteria like market size, in order to evaluate market attractiveness, we have to give it a weight and a rating, and then we calculate the value, which is the weight multiplied with the rating. Now, the big question here is, who is choosing the criteria? They cannot just be chosen randomly. It has to be good criteria. Otherwise, the market attractiveness indication won't last. And who's choosing the weight? Is it us? Is it other consultants? Is it something that we need help with? And who's doing the rating? And therefore, we can always question the number down here. Is it correct? Because we might find a situation where it's not the right people who rated it, it's not the right weight, and it's not the right criteria. But if we can hit it quite right, then this can be an indication and a great strategic tool to us. But you can think about this way of doing it, but it takes a lot of time, but we are back to opportunities and threats and strengths and weaknesses. Yes. And then, of course, there are some difficulties with portfolio matrices. And BCG, only 2 factors, dubious recommendations, etc. And I've just touched upon some of the other things as well in the last slide. We'll move on to the last one about this one, tools for corporate level options from acquisition to restructuring. And that is kind of ending the lecture today, but we just have this one. Over here, when we acquire something, simply take over another company, then we have this very high degree of ownership. And we are simply just including something or excluding something from what we do, then we have a low one. The interesting thing here is that we have this in the middle about alliances, and we can acquire things. So again, it's about diversification. It's about how much do we want to own of our SBUs, and how many SBUs do we want to own. So that's the end of the lecture slides, and thank you for listening in.